Let's dive deeper into fund types, a critical distinction that directly impacts the liquidity of your Golden Visa qualifying investment. In the world of Golden Visa eligible funds, there are generally two types, open-end and closed-end funds. Understanding their differences is key to making an informed decision, especially when it comes to getting your money back. So let's start with closed-end funds. These are often referred to as venture capital or private equity funds. In Portugal, they're called FCRs, Fundo de Capital Risco, which literally is risk capital funds. They are inherently risky, it's in the name. FCRs have a definitive life cycle, typically 6 to 8 years, sometimes 10 in the Golden Visa context. When you invest, you are essentially subscribing to a fixed-term investment, although some funds do reserve the right to extend. The fund takes your capital and invests it in illiquid assets, things that are not easily or quickly sold, such as classic cars or cattle, stakes in European football clubs, private companies, or specific projects like boutique hotels and solar farms. The fund's objective is to grow those assets over its fixed lifespan. At the end of the fund's life, the goal is to sell those assets, convert them back into cash, and return the investor's capital along with any potential gains. This process is called fund redemption. A critical factor to weigh is the time frame. A 6 to 8 year window is a very short time span to grow and successfully exit a private investment. This can lead to a liquidity trap, which I cover in detail in my video, How to Manage Golden Visa Liquidity Risk. You can find a link in the video description. Now let's look at open-end funds. These are often similar to what we think of as mutual funds in the US. They have an evergreen or indefinite lifespan. Their investments are typically in more liquid assets like publicly traded stocks or bonds, so a market for these assets pretty much always exists. This means investors can usually buy and sell their fund units at any time, subject to the fund's terms. Because of this, open-end funds are considered liquid. This liquidity is attractive, but it comes with its own considerations. You can get your money out more easily, but the potential gains tend to be lower, and you are still subject to market volatility. The value of your investment can fluctuate daily, and you may need to wait for a favorable market cycle to exit without a loss. Regardless of which fund style you choose, you must consider the tax consequences. For U.S. citizens, a foreign investment may be classified as a passive foreign investment company, PFIC, or a CFC, a controlled foreign corporation, for U.S. tax purposes, even if it's a simple investment. Understanding these rules is a critical part of your due diligence. I dive into this topic in my video, Navigating U.S. Reporting with a Golden Visa Investment. Ultimately, the choice between an open-end and a closed-end fund is a trade-off between liquidity and investment strategy. Your decision should align with your personal goals and risk tolerance. Understanding the different timelines and tax implications of each is a crucial step in protecting your investment and your financial well-being. For a full education on all these topics and more, including how to perform the due diligence on a fund's investment strategy, I welcome you to join the Don't Get Burned Golden Visa Risk Masterclass.